Hey everyone, welcome back to the channel. Today, we're diving into a question that's on everyone's mind. What happens next in the stock market? A crash or a boom? With headlines flashing about high inflation, rising interest rates, and geopolitical uncertainty, it's easy to feel anxious about your investments. But the truth is, the market is never predictable, and understanding the forces at play can help you make smarter decisions instead of panicking or chasing trends. So let's break down the key factors that could drive a crash or a boom in the coming months, the signals investors are watching, and how you can prepare. 1. The current market environment. Right now, the global stock market is in a state of uncertainty. Some indicators are positive. Corporate earnings, especially in tech and healthcare, remain solid. Consumer spending in some regions is holding up. Some sectors are benefiting from innovation and productivity growth. But there are also warning signs. Inflation, though slowing, is still above target in many countries. Interest rates are elevated, which increases borrowing costs and can slow economic growth. Global growth forecasts are lower than in previous years, suggesting a more cautious economic environment. The combination of these forces makes it hard to predict whether the market will soar or stumble. 2. Factors that could trigger a crash. Let's start with what could cause a market decline. Central banks have raised rates to fight inflation. Higher rates mean loans become more expensive for companies, which can reduce investment in hiring. Consumers face higher borrowing costs, which can slow spending. Bonds become more attractive relative to stocks, which could pull money out of equities. Even if the economy is growing slowly, investors expect companies to perform well. If earnings reports miss expectations, especially from large-cap tech firms, it can trigger sharp sell-offs. Trade conflicts, sanctions, or unexpected crises can spook markets. Supply chain disruptions, energy price spikes, or political instability can cause sudden drops in stock prices. Markets often move based on emotion as much as fundamentals. If fear spreads, triggered by negative news, headlines, or predictions, it can create a self-fulfilling downward spiral, even without major economic changes. 3. Factors that could spark a boom. Now let's look at what could push the market higher. If companies exceed earnings expectations, particularly in sectors like technology, AI, and green energy, it could fuel a rally. Investors love growth stories, and profitable innovation can drive markets upward. Governments can support growth through fiscal policies, like infrastructure spending, tax incentives, or support for strategic industries. This extra capital can boost confidence and market performance. Technological breakthroughs, digital transformation, and AI-driven productivity could create strong corporate profits and higher valuations, even in a slower growth environment. Markets often climb when investors expect positive outcomes. Confidence in the economy, interest rates stabilizing, or trade tensions easing can push stock prices higher.
4. What the experts say. Analysts are divided. Some warn of a potential market correction, citing high valuations, slow growth, and interest rate risks. Others argue that strong fundamentals in tech, healthcare, and select growth sectors could support a continued bull market. The key takeaway? There's no crystal ball. Markets are influenced by thousands of factors: economic data, geopolitical events, corporate earnings, and even human psychology. 5. How investors can prepare. Whether the market crashes or booms, here's how to protect yourself. Diversify. Don't put all your money in one sector or stock. Spread across regions and asset classes. Focus on quality. Companies with strong balance sheets, consistent earnings, and competitive advantages are more likely to withstand a downturn. Keep a long-term perspective. Market dips happen, but historically, long-term investors recover and grow wealth. Consider cash or flexible assets. Having liquidity allows you to take advantage of opportunities if the market dips. Stay informed but avoid panic. Follow reliable data and avoid reacting emotionally to headlines. 6. Key takeaways. The stock market could either crash or boom depending on interest rates, corporate earnings, geopolitical events, and investor sentiment. High valuations and slow growth create risks, but innovation, stimulus, and strong corporate profits offer upside. Diversification, focusing on quality, and keeping a long-term perspective are your best tools for navigating uncertainty.
Outro. So, what's your take? Do you think the stock market is headed for a crash, or will we see a surprising boom? Drop your thoughts in the comments below. I'd love to hear your perspective. If you found this video helpful, hit the like button, subscribe, and turn on notifications so you don't miss our next market deep dive. Thanks for watching.